This is the Daily Market Rundown live from the Tradelo trading floor. It's April the 11th. Some highlights from today's show. China signals a very important turning point. The world says no to USA, and Michigan data is now in focus. Good day traders, welcome. Happy Friday. What a week it's been. It's gone by in a zoom, and you know what? It's not about to get any slower. We've got very much a lot of headline risk, which continues today and also continues to the weekend. And I think that's a key sort of thing to keep in mind as we, of course, trade out today and trade into the weekend. Headline risk is at a maximum now over the weekends, given how fluid the situation is on the tariff front. What the headline risk means ultimately is that over the course of the weekend, we've got 2 days where the markets are shut and China and the US can lob bombs at each other and throw all sorts of rhetoric out there left, right and center, and there's 48 hours in which investors kind of have to get beyond the weekend. Now, it's important to understand, of course, what is the context of where the current situation is in terms of tariffs, because that'll ultimately define where the risk reward is, and we'll talk a little bit about that. With that in mind, let's get across and talk about our first topic, which is very much this idea that China has ultimately sent a very, very important signal very early on this morning. Now, as of about an hour ago, we had a new headline that the Chinese are now going to lump 125% tariffs on the US. But that's as far as they're going to go. And I think that's a massive, massive olive branch. You've got to learn to read between the lines there. What they're kind of saying is the joke is up. We can't keep doing this. And guess what? The market latched onto this about 2 days ago. If you look at how the market traded, of course, if you cast your minds back to earlier this week when the US first retaliated, really there was no significant risk off as a result of that. And then when China escalated again, put the tariff rate up, again, the market's reaction function was not panicked. And what this tells us is that the market is seeing through this, sort of backwards and forwards, just putting these ridiculous numbers out there, rather focusing on the upside, the turning point, the point at which we see the escalation start to actually de-escalate. And that's key because I suspect now the real play, the real risk reward is actually on de-escalation, not more escalation. And on that note, of course, yesterday Trump came out and he started talking very positive about his big buddy Z. Okay, Xi Jinping, he started talking about what a great leader is and what friends they are, and he thinks there'll be a deal. So not only did we get that positive spin yesterday from Trump, we've also had the Chinese now coming out today and saying, you know what, actually this is as high as we're going to go on the tariffs because these numbers are a bit of a joke. All of this, I think, reading between the lines suggests that headline risk for this weekend really favors a positive sort of de-escalatory type comment over the weekend. And so I wouldn't be surprised if Sunday, we're coming in and we're having to buy the open of the equities for some sort of a stop up, some sort of a liquidity event on Sunday night. Now, very importantly, there's a couple of other topics we'll pay attention to, but I think one of the key sort of takeaways from yesterday's session, and this is in the Bloomberg this morning, Bloomberg is talking all about this idea that treasuries are now becoming very similar to emerging market type bonds. Now, we've seen this sort of episode play out in the gilt market 2 years ago when Liz Truss came out and presented a budget that was unfunded, and ultimately gilt started trading a little bit like emerging market bonds. Now, if you've been watching the T-note over the last 2 or 3 sessions, okay, don't forget, on Wednesday we had a significantly strong 10-year bond auction, and yesterday we had a 30-year auction that stopped through the screws. First time in a very, very long time we've had such a significant strength at a long-dated bond auction. And yet, what did the bonds do? Well, they paired off, they sold off, and they continued this march lower. So there is a lot of nervousness around the bonds. Does that mean everyone's suddenly going to start puking and panicking in bonds and giving up on being long US treasuries? No, perhaps not, but the tides are shifting, and we'll talk a little bit about that when I present you a chart in a minute. Fantastic chart article to go read in the Bloomberg this morning. Go and have a look at that. Now, with that in mind, like I said, it's very much headline risk again today. There is the article. China raises tariffs to 125%, but says it won't go higher. Okay, and I think that's massively positive. I appreciate the markets are not quite responding to it in that way yet, but I suspect what this means is that now is the time to put on those risk reward plays. Now is is the time to look to be trading that S&P back up towards that 5,700, particularly if we do start to de-escalate a little bit. Okay, now just because we get back up to 5,700 doesn't mean we're not going to go lower and make a new low in the year. I think that's very much the play and the scenario, because I do suspect we are already in some form of a recession, and we'll talk about the Michigan in a minute, because I suspect that's going to be the first clue later on today when we get the latest preliminary announcement. Now, as we've done all week, we've been looking at these sorts of different options in terms of what next, in terms of headline risk. What else could they say? Well, look, if there is going to be an escalation, it's not going to be via tariffs. Okay, it doesn't make any sense now for the US to come out and say, we're going to put 200% on you, 300% and 400%, because all of that's really a joke. Okay, and the market sees it as a joke. The market sees it as, this is nothing more than just bluster. Where could there be more retaliation? Okay, well, there could be some non-standard measures. Okay, things like, for example, the China comes out and they say, well, look, we're going to threaten to weaken the yuan. Okay, some form of a devaluation. Perhaps they come out and cut interest rates. Perhaps they fire a bazooka in terms of a fiscal spending package. All of these sorts of things will be taken ultimately as a little bit of a retaliatory scenario. Why? Well, because it means they're going to accept the higher tariffs and safeguard the domestic economy. Now, we're not necessarily at that point yet. I suspect the next part of this chapter is going to be, Trump and Xi agreed to get on some sort of a phone call, and that ultimately will be the beginning of a de-escalatory type environment. Okay, now, the market's waiting for that. The market is genuinely waiting for that. I think everyone's sitting there going, okay, when's it coming? When's it coming? When's it coming? They are going to hold a phone call. These tariff rates are going to be lower than what they currently are right now at some point in the next couple of days or hours, days and weeks, and the market is very much just waiting for that scenario. And as I said, that scenario could play out, of course, over the course of the weekend. Now, another interesting sort of thought in terms of reading between the lines, this is the first time Xi Jinping has made public remarks on the escalating trade war. Okay, that matters, because I suspect what that means is that, we are going to see this phone call happening anytime soon between Xi Jinping and Trump. And then also he went on to say, and I think this is crucial, and it's a fantastic segue for me, he went on to say that one that goes against the world risks being isolated themselves. And this is sort of, right out of typical Chinese proverbs, which is, if you're going to go up against the world, you are going to isolate yourself. And I think what he's ultimately pointing toward is, look, US, you might be trying to gang up on us, but in actual fact, everyone is ganging up on you. Now, with that in mind, we can see it on the charts. Okay, this idea that, the US is no longer exceptional and the world is no longer bowing to the US is very, very obvious on the charts. So what you're looking at here is a rebasing chart since the start of this month. And if we just start off and look at the S&P 500 in this dark purple, we can see it's down 6.5% this month. If we compare that to the DAX, okay, as of to date, the DAX is down 8.5%. But if we look year to date, we can see the S&P currently year to date is down 12%, and the DAX is currently up 2%. So we've got a 14% divergence between, the US's main stock market and Germany's or Europe's main stock market. Okay, so that's significant. That's the first place we're starting to see a little bit of, sort of move away from the United States and into other alternatives. If we then look at the bonds, okay, you go look at the green line here, we can see that ultimately the bunds this year are marginally, sorry, if we look at the purple 10-year line, we can see that the US 10-year notes are currently down 1.38%. Okay, and we can see that the bunds are currently up on the year. All right, so again, pointing towards almost a 2.5% spread in terms of prices between the US and the German equivalent. If we then go and have a look at the dollar index, okay, similar kind of thing. The dollar index is down 6.5% over the course of this month. Okay, so we are seeing a lot of dislocations here now where money's flowing out of the United States, out of the US stock market, out of the US dollar, out of US bonds, and into alternatives. Okay, and this is this exact idea that Xi Jinping is saying, is that if you're going to go up against the world, if you're going to tear up the world order, don't be surprised to see everyone lose trust, lose faith in the stability the United States offers. And ultimately, that's what investors are doing. They are very much voting with their feet. And again, it plays along the lines of the same article, which is, hey, if no one wants to really sort of be very aggressively buying up treasuries anymore, is that going to sort of create some sort of a de-anchoring in the world order? So keep a close eye on that. Look, it's not a case of treasuries are going to start puking. It's not a case of, we're going to see 10% yields. That's not what I'm sort of pointing towards. What I am pointing towards is there's now a better alternative in terms of safe havens, and that safe haven we'll talk about in a moment. Now, with that in mind, longer dated bonds were in focus yesterday. Why? Because the bond auction stopped through the screws. Fantastic bond auction. I mean, as good as it gets. You would have thought, given we've gone from 4.30 to 5% over the course of this week, you would have thought bond yields would have pared back a little bit today. Well, guess what? They're sitting right up at that 490, only 10 basis points away from the high of the week. This is scary times. Okay, now it's not to say that we're suddenly going to ramp up, but what it is to say is that there is genuine fear in the long bonds. And when the long bonds are moving like this, if we do get above that 5% next week, and we do get above 520 at some point, just watch out. Okay, that is going to create ripple effects in the markets. That's going to create just a number of break points. Think high vol, think and continued sell-off in equities. Okay, we cannot sustain high 30-year yields at this point in time, given how high the VIX is currently. Now, with that in mind, this is a little bit of bond spread porn. I absolutely love this chart. What you can see here is the spread in orange between Germany and the US. And again, this just highlights what's actually happened this week. This highlights this idea that, the US is playing with fire, and perhaps ultimately we could be seeing a generational shift where the US is no longer seen as the only game in town. It's no longer seen as the only place you can park your reserves. Okay, what's happened over the course of this week? The spread has blown up 45 basis points. Okay, this doesn't happen easily. This is a very dramatic move to see happen in 1 week. At the same time, you can see the MOVE index, which is the bond volatility index, has absolutely flown up the page. We're at the highest levels we've been pretty much since COVID times. Okay, so what this is telling us is that there is real, sort of a breakdown in, the biggest market in the world, which is the US bond market. Okay, we are seeing money flow out of the United States into the likes of Germany, into the likes of JGBs in Japan. We are seeing money move away from the United States. Okay, again, why does this matter? Well, because look, if this is a generational shift, what it means is longer term, dollar's in trouble. The reserve status is not necessarily in trouble, but we are going to see many, many countries start to move away from being over leveraged and sort of over dependent on the United States. Okay, what that means is other stock markets will start to do better, other currencies will start to do better, other bond markets will start to do a lot better. Okay, now let's move on and talk about our final topic today, because I think this is the actual where the markets are going to focus the attention today. It's all about Michigan. Okay, I said this in yesterday's daily market rundown. What matters less now is the tariffs, and what matters more is the economic situation. Okay, don't forget, the risk was not about high tariffs. The risk was about high tariffs causing a recession. Okay, the risk of a recession is rising every single day. Just because we have a 90-day delay does not mean the risk of a recession is gone. If anything, that risk is very much where it was at the start of the week, and it continues to escalate. Now, why does Michigan matter so much today? Well, I think the way to look at this Michigan is to actually point your attention to what we had over the course of last year. So if I just show you this little line down here, what you'll notice was we had quite a significant little slowdown effectively in the data. And what happened was, if you go back to last year's Michigan and you look at the July print, you'll see that we had the weakest print in the Michigan somewhere around that 50 mark. Now, why does that matter? Well, because what happened ultimately after the July print last year was we had that very, very weak non-farm prints at the start of August. Okay. Now, I'm not suggesting we're going to get the same thing, but remember, the Michigan's simply a survey. So people just go out and ask a number of questions about the current state of affairs. And if everyone's getting sort of losing their jobs and people are kind of, just feel like it's the end of the world kind of situation, we are going to see that in the Michigan data today. Okay, don't forget, since the last survey, what's happened? Well, the stock market dropped 20%. That's going to impact a huge number of people. We know that the consumer spending was weakening already in Jan, February, March. So it almost feels like this could be a climatic type Michigan where we get a stupid number. Okay, what does a stupid number look like? Well, anything less than 50 is going to be an absolute head scratcher. It is going to put that big R word right back on the map, which is recession. Are we already in a recession? Okay, now, It doesn't mean the markets are going to puke 5% in a straight line, but keep in mind with the VIX sitting very, very elevated, we could well see that S&P down 4.5%, 5% again at some point today. But like I said, given the vol, it cuts both ways. We could see the S&P down 4.5%, 5%. We could also see it flat on the same day. Okay, don't forget, there's a lot going on right now. There's a number of different things that can happen over the course of today, but Michigan is going to be a key focus. Okay, with that in mind, should the number come in line? Should the Michigan number come bang in the screws, bang in line, perhaps even a little bit of a beat? Again, it really will add a bit of positive spin into the equities. And like I said, don't forget, the S&P, the VIX is so high that we could be up 2, 3, 4% on the day, just simply because of the nature of volatility and implied vol right now. Okay, so it's all bets to the upside or to the downside. Anything can happen. Like I said yesterday, we've got to keep very, very nimble on this. One final note, like I said, you do need to pay attention, of course, to the weekend risk. There is a significant risk of some positive news out this week, and I genuinely think that matters. What that means is this is one weekend I do not want to have a position on over the weekend because I do think there is likely to be some potential headline risk. So with that in mind, of course, we will be very active over Sunday should we get some positive news. But of course, I will update you in the Discord channels over the weekend. So with that in mind, if there are any other questions, do post them in the Discord channel. Otherwise, as always, manage at risk. Stay safe out there. Good luck out there. Manage at risk. Go make some money.